Welcome to this urgent explainer. Look, if you operate in the surplus funds recovery space, you already know the ground beneath your feet is shifting incredibly fast. For years, the margins in this industry have been pretty comfortable, which makes this upcoming regulatory shift really jarring for veteran professionals. Today, we're extracting some absolutely critical industry insights from a highly impactful new report. We're going to look closely at some aggressive new regulations appearing on the horizon, specifically coming out of California, and what they signal for the rest of the nation. Make no mistake, this isn't just about pending legislation. It is fundamentally about the survival and adaptation of your entire business model.
So let me ask you, is your recovery business ready for a 10% fee cap? For a lot of third-party asset finders, this isn't just some hypothetical what-if scenario anymore. It's a direct impending threat to current revenue structures. If your business model heavily relies on higher margins or upfront charges, what we're about to cover is an absolute wake-up call. The days of standard, comfortable fee structures are evaporating, and honestly, those who aren't preparing for this right now are going to find themselves structurally unprofitable in the very near future.
All right, Section 1, the California Fee Cap, Understanding AB 2705.
10%. That is the number you absolutely need to burn into your memory today. Under current California law, professionals are allowed to charge the greater of $2,500 or 5%. But California Assembly Bill 2705 completely dismantles that structure. It reduces the allowable fee down to a strict maximum cap of just 10% of the excess proceeds that are actually awarded. To put that into perspective for a second, on a $10,000 excess, the allowable fee drops from $2,500 down to a strict maximum of just $1,000. That is a massive hit to your operational cash flow, and you have to start accounting for it immediately. And you know, it's not even just about the cap. AB 2705 fundamentally rewrites the rules of third-party recovery agreements. Along with that strict 10% fee cap, it enacts a total ban on all upfront charges. This means the cash flow risk shifts entirely onto the recovery professional. You literally cannot collect a single dime before a claim is approved and the funds are actually paid out. Plus, it mandates a written disclosure explicitly telling the former owner that they can file their claim directly with the county for completely free. And finally, it strictly prohibits bypassing proper legal documentation. So no more trying to use notarized affidavits in place of actual, required probate paperwork. The regulatory net is seriously tightening.
Section 2. What sparked the legislation? The regulatory record. To understand exactly why the rules are changing so drastically, we have to neutrally examine the catalyst for this legislation, which actually comes directly from major counties themselves. County clerks aren't exactly known for their flexibility, right? And specific abuses have given them the exact ammunition they needed. Over in Riverside County, officials reported instances of asset finders misrepresenting available excess amounts, trying to bypass those strict probate requirements we just talked about, and in some extreme cases, using straight-up fraudulent documentation. Then, in Los Angeles County, they reported companies acquiring interest in tax-defaulted properties after the sale had already occurred. They were essentially positioning themselves to file claims as supposed parties of interest, rather than actually assisting the original claimant. Now, it is absolutely vital to understand that these specific county reports are not an indictment of every professional in the industry, but they are the exact reasons driving this specific legislative action.
As Kim Harris from Overages Overflow points out in the report, this is the regulatory record California legislators are acting on. Because these specific major counties named these exact abuses in official committee analysis, lawmakers now feel they have a concrete, undeniable justification to aggressively regulate the entire space. They aren't just guessing at a problem here. They are reacting to a documented public record.
Section 3, the national regulatory trend. Why this is not just a California problem. Now, this brings us to a vital realization. If you operate entirely outside of California, you might be tempted to just tune out. But hold on, because California and Florida almost always set the legislative weather for the rest of the country. While California is proposing a strict 10% cap, Florida has already crossed that bridge. Under Florida Statute Section 45.033, which was updated in 2025, Florida has already enacted a strict 12% cap on assignee fees. They also already require agreements to state that owners can recover funds without using an agent at all. When you contrast these two massive markets, it becomes incredibly clear that severe fee caps and mandatory disclosures are rapidly becoming the standard, not the exception. And then you add Texas into the mix. Texas now outright bars non-attorneys from charging fees for tax sales surplus recovery. No way, right? That is a massive escalation. The legal walls are closing in. The pattern across the nation is just undeniable at this point. States are systematically scrutinizing how third-party recovery agents operate, and they're rapidly layering on intense consumer protections that could completely lock out unprepared businesses.
The report actually gives a really explicit warning here. Treat it as the playbook every other state will eventually copy. California's AB 2705 is simply the most detailed and comprehensive version of this regulatory trend to emerge so far. Other states now have a ready-made legislative template, complete with documented justifications, to just pass their own versions. This is your blueprint for the future, no matter what state you operate in. Ignoring it, yeah, that's just no longer an option.
Which brings us to Section 4, the Defensible Recovery Agreement, your 2026 compliance playbook.
Okay, let's dive into this. How do we actually pivot from the problem to the solution? Well, you have to future-proof your business right now. First, voluntarily set your clearly stated fee percentages at or below the applicable state caps. Just do it now. Next, you must include explicit written disclosures stating the former owner can file directly with the government at absolutely no cost. Furthermore, absolutely prohibit any fee collection before awards are paid out. You also need to require proper, full legal documentation. If probate is required, don't try to substitute it with an affidavit. And finally, ensure your language only assigns the specific claim in question. Absolutely no blanket assignments of future rights.
But listen, here is the hidden trap in all of this. Even if you draft the absolute perfect compliant agreement using those 5 steps, you can still fail. Why? Because clean documentation starts with clean data. Imagine this for a second. You have a perfect, fully compliant $50,000 claim, but because of a single tiny transposed digit in a parcel number, the entire package gets thrown out. It's agonizing. If your beautifully worded agreement cites the wrong parcel number, spells the owner's name incorrectly, or lists an inaccurate excess amount, you instantly create legal exposure. And more importantly, those minor errors act as glaring red flags to county clerks who are already actively looking for reasons to reject third-party submissions.
Section 5, Future-Proofing with Clean Data, the AI extraction solution.
So the crucial point is, how do you actually eliminate human error from that process? Well, according to Kim Harris's report, solving this really requires specialized AI. The Xtract system, for example, identifies the 9 critical data fields required for every agreement with a documented 99% accuracy rate. This ensures the foundational data of your documentation package is completely accurate the very first time. No more of those costly, agonizing rejections. And get this, the report highlights that this method is not only highly accurate, but it operates 100 times faster than manual data entry. 100 times. That is a staggering leap in efficiency. It gives recovery professionals leveraging this type of AI a massive operational advantage, allowing them to scale their compliance securely without getting bogged down in endless, mind-numbing spreadsheet verifications. The data supporting this is pretty substantial, too. The system automatically pulls those 9 critical fields, it has successfully processed over 100,000 documents, and it's actively trusted by a network of over 1,000 surplus funds professionals. When the regulatory stakes have literally never been higher, adopting established, automated standards for getting your data right the first time is no longer a luxury. It is an absolute necessity for survival. Which leaves us with one final, absolutely critical question for you to ponder today. Will you treat this explainer as a wake-up call and restructure your agreements today? Or are you going to wait and face a panicked scramble when these regulations inevitably land in your state? The blueprint is clear. Those who adapt their data and compliance right now are going to thrive, and those who ignore the playbook are going to struggle. Don't get caught off guard. Take action and start future-proofing your recovery business today.
Right now, surplus funds professionals can easily navigate their workflow for this underexposed stream of leads using Xtract. Those who move first on a new county list always win the most claims. The ones who wait fight over scraps. Xtract pulls all 9 critical data fields from any county surplus list in seconds at 99% accuracy. No manual transcribing, no falling behind. Start your free trial at exactextract.com and start extracting the exact data you need.